This is Briant Sikorski with Stratos Wealth Partners. You should see on the screen my biography, and you can see that as a wealth advisor, I help clients work toward investment goals, including personal and business retirement planning, education savings, first-time home purchases, catastrophic risk management, estate planning, wealth management. I provide clients access to different insurance and investment vehicles. I specialize in retirement planning, business retirement plan like 401k rollovers to IRAs and wealth management. I also work with small business owners to put into place executive compensation plans and the implementation and or takeover of business retirement plans. I entered the financial services industry after a 20-year career in venture capital, information technology, telecom, and automotive manufacturing industries. I hold a Bachelor of Science degree from the University of Michigan and a Master of Business Administration from Oakland University in Michigan. And here is my photos. When you see me on the street, you can say hi. So today our topic is insurance and why life insurance now of all things. So the question being is, what is happening in today's environment? We're going to cover that. We're going to talk about why life insurance might be appropriate for more than one reason. I think most people think of life insurance exclusively from the perspective of only covering the incident of a death. So we're going to talk about that. And then I'm going to actually cover a little bit of a particular type of life insurance that has become very popular lately, and you'll see why in just a second. Before I forget, I will share with you that this is being recorded, so that's why you're all muted at the moment. If you have a comment that you need to share, go down into the chat box and type something in. I will also share with you that when this is done, it will be recorded. It's being recorded, and it will be distributed to all of you. So you'll get an email with a copy of the presentation and all the documents as well. Okay. Oh, and before I forget, I'll also upload it to my YouTube channel. So if you go to BriantSikorski.com and click on my YouTube icon, it'll take you right to YouTube, and you can watch it there. So if you miss anything or you don't quite understand something or you want to go back to it one more time, you can do that. Watch it as many times as you like. Okay. So what's going on in today's environment? Well, we see, particularly with some discussion in the most recent tax code, we've seen a growing national debt that just shows no end in sight, I guess, number one. Now, while I see number two here says increasing taxes, well, while the federal government did, the current administration did lower marginal tax rates, there are also a number of deductions, exemptions, specifications that have been eliminated. So I don't think a lot of people really know what their tax responsibility is going to be until they actually do their taxes next year. There are new taxes that have been implemented, particularly at the state and local levels. While we've seen a decrease in federal tax rates, we've seen a pretty hefty jump in state taxes, most notably the coasts, New York on one end and California on the other end, local taxes in cities, and also significant increases in property taxes. I don't know if you've seen some of the articles about the federal government trying to I'll say extract a payment in lieu of taxes for what we typically saw as nonprofit entities such as colleges, universities, and even churches now are being pandered, if you will, or threatened if they, in order to pay some kind of tax. So I'm not so sure that in the longer term, yes, I understand the administration did lower the marginal tax rates in the short term. I just honestly don't see in the long term how that's sustainable unless we see a significant continued increase in our gross domestic product. Because if we reduce the percentage of taxes, we've got to make that up in volume of earnings being generated, which does seem to be occurring, but in my opinion, again, not anywhere nearly as quickly as necessary. At the same time, we have an aging population. As the baby boomers move through retirement and beyond, we're going to see rising health care costs, and we saw that regardless of the Affordable Care Act. In fact, some of the percentage increases in the Affordable Care Act premiums exceeded the types of increases that were typically experienced by private insurance in the past. And we're seeing an expansion of federal subsidies for health insurance. So, any way you look at it, like the next slide shows us, with our national debt at $19.258 trillion and growing, some way, shape, or form, we're going to see an increase in some kind of tax and decreases in certain types of federal benefits or services. I know that as recently as in 2016, the Democratic Party, was kind of laying a trial balloon to see what would happen if they proposed, higher taxes on death, estates, Social Security, things that previously were not taxed. I can feel the underpinnings of a dialogue about taxes within the next couple of years. So the question being, does the U.S. have a tax problem or a spending problem, or both? And I guess the moral of the story here is I'm going to be covering maybe just a couple of contemporary ideas that might, as they say, kill two birds with one stone for you. So number one, might be able to give you life insurance protection and at the same time take into account the changes in our current economy, and likewise look at ways to enhance our portfolio with the inclusion potentially of life insurance. So why do I say life insurance? I think when most people think of life insurance, they have a tendency to think about these two common questions. Number one, what do you do? What if something happens, and when are you going to do it? So what if I die, and when I die eventually, what am I going to do to take care of my loved ones here, my two future Navy SEALs? I will tell you from personal experience, my father died when I was 17 years of age, and my mom and I had absolutely no idea what we had. We didn't know anything about money. We didn't know if we had a mortgage, didn't have a mortgage, did have a checking account, didn't have a checking account, and we found essentially life insurance policies, in drawers around the house, and so It took us the better part of the year to figure out what my dad had done because we had no clue. And in the final analysis, we realized that by far he didn't have anywhere nearly enough life insurance, and it was only through predominantly I should say through his employer, and then a couple of supplemental policies that he purchased through either AAA or the Knights of Columbus or something like that. So if I'm not mistaken, I think that my dad had about $40,000 in life insurance when he died. So maybe that was a lot of money back then, but it didn't seem like it. And it certainly doesn't seem like it now. So what would happen if I died prematurely? Would my family have the assets to continue their current lifestyle? Would there be money for college, final expenses, or estate taxes? And this is the part that, again, most people don't think about, is what would happen if I lived longer than I'm supposed to? If my life expectancy is 85 and gosh darn it, I live to be 90 plus, am I going to have the retirement assets necessary to sustain my retirement? So while the death benefit is without a doubt the main reason that people buy life insurance, because it passes on, and this is the key here, income tax free to the beneficiaries for income replacement, supplemental college funding, business succession, I'll come back to that, mortgage and other debts, final expenses, funerals, etc., and the payment of estate taxes if necessary. Business succession is one that might not jump out at you, but that would be a scenario where, let's say you and I were partners in a business, and if one of us died, we would want the remaining ownership of the business to go to the surviving partner, and you would want the cash for that transaction to go to the widow or widower who came as a result of the death. So if you and I had a succession plan and we had life insurance in place and I were to die, then my estate would pass over the remaining ownership of the business to you in exchange for the life insurance proceeds equal to half of the value of the business going to my spouse. So that's how business succession utilizes life insurance. You'll also see some banks, credit unions, etc., will require a life insurance policy if a business loan is made. So if you're starting a business and you borrow $100,000, you'll have to take out a $100,000 life insurance policy to cover that debt, so that if you die, instead of repaying the debt. So what kind of concerns do we have? Well, we have concerns for others, such as providing for beneficiaries in the event of premature death. My dad was 49. I think that was probably pretty premature. Saving for college, continued support, kind of interesting for your favorite charity. Now, here's the key part here is, first point, is tax rate uncertainty. Now, if I talk to the majority of people, I ask them what are they doing to save for retirement, they say, well, I've got money in an IRA or a 401k, probably 8 out of 10 times is what they'll tell me. A couple times they'll tell me maybe a Roth IRA or something like that. But what do we know about a 401k or an IRA? Well, we get a tax deduction today, or we get to fund the account with pre-tax dollars. What happens when we take withdrawals at retirement? Well, those are taxed just as if it were income. So if you withdrew $20,000 and that puts you in the 15% tax bracket because it's just like earning $20,000, then you'd be liable on the hook there for $3,500 in tax liability. And if you think about it, if you have a 401k or an IRA, you might very well have contributed that for 20, 30, 40 years. And so if it's $500,000, you could be in a scenario where you've saved, pick a number, $50,000 in taxes today, but you ended up owing $100,000 taxes in the future, and that because of the growth of the account, and that can be significantly exacerbated if taxes, God forbid, are higher when you retire than while you're working. Because that's the whole logic behind the model. The whole logic is that I'm going to take a tax deduction today when I'm in a, quote, pick a number, 30% tax bracket, and I'm going to take withdrawals in the future on a taxable basis, but I'll be in a lower tax bracket. Well, what if I'm not? The whole model collapses. So, with this, with these numbers of the national debt staring us in the face, I very much encourage people in their retirement account to maybe have a 401k or an IRA, maybe an annuity if it's appropriate, maybe life insurance if it's appropriate. So again, that way, if retirement comes and they need money, if they could take it from either their IRA or their Roth IRA or their annuity or their municipal bond account, because each one of those types of accounts is going to have a different tax scenario. So for ourselves, to resolve tax rate uncertainty, to potentially accumulate money for retirement and address potentially outliving our retirement savings. And this is an interesting one, is inflation. Inflation has been relatively low for the better part of the past 10 years now, but it wasn't too long ago, back in the Jimmy Carter administration and the early phases of the Richard Nixon administration when inflation was double digits. That was back when we had CDs that paid 12% and mortgages that were 14%. So what is the difference between term and what some people will call cash value? Some people will call it permanent. So what is term insurance? Term insurance is by far lower cost, at least initially. And in most cases, the premiums will increase over time. They will not accumulate any cash value. It's kind of no different than your auto insurance or your homeowner's insurance. And the coverage will typically stop at the end of some period of time, 10, 15, 20 years. So it's almost, I kind of use the example, it's almost like renting a house instead of buying a house. You might be able to rent a house a little bit cheaper, a little less expensive at the outset, okay? But over time, buying your home and the appreciation of its value might catch up and pass that of a rental. So term insurance, generally lower cost, at least initially. The premiums can generally increase over time, and I'll show you a couple of variations of where they do and do not in a minute. They do not accumulate any cash value, and here's the key, is typically coverage stops at the end of the term. So if you are 20 years old, 30 years old, let's say 30 years old, and you buy a 30-year or 20-year, 30-year term policy, and you're paying, pick a number, $200 a month, well, when you reach 50 or 60, that term stops. And you could have a scenario where you've experienced a medical diagnosis that makes you uninsurable. So you can't buy life insurance at any cost, number one. And number two, maybe it was $200 or $300 a month when you were in your 20s or 30s, but maybe now it's $250, $500, $600 a month, several $1,000s a year. And you can't afford it down the road because it's going to jump. It'll go from hundreds per year to thousands per year. So what is cash value or permanent life insurance? Well, it is the type of insurance that stays with you forever, typically, okay? They will typically be a higher cost initially, but here's the difference is the premiums stay level forever. So this kind of never goes away, hypothetically, unless and until you pass away. And if the underlying investments within the insurance policy do some kind of performance, you could actually accumulate some type of cash value. There are certain scenarios where you can even have flexibility of premium, where if you have a rough year, you can reduce the amount you pay. And here's the real key that we'll get to again in a minute, is you see at the bottom it says policy, loan, and withdrawal options. So what this means is that at some time in the future, if you see that you have a very high tax rate, you can withdraw some of your original principal, or you can withdraw through loans the appreciation in the life insurance policy. And both of those withdrawals will be tax-free. If you were to die, your death benefit will be reduced by these withdrawals, but nonetheless, you can do it. So you can have a scenario where a withdrawal, a loan, or death benefit payment is made. In all three cases, it's tax-free. So this kind of shows us that if designed properly, cash value life insurance will typically remain constant. It will remain at a stable value. Okay. All right. So life insurance can offer a combination of three tax advantages that no other insurance product offers. First and foremost, the death benefit is tax-free to the beneficiaries. Second, the cash value has the opportunity to grow and accumulate on a tax-deferred basis. And last but not least, as we just mentioned, you can access available cash value, accumulation, income tax-free through policy loans and withdrawals. And so to receive these income tax benefits and to ensure the cash value accumulates on a tax-deferred basis, the Internal Revenue Code regulates the relationship between the death benefit and the cash value accumulation. So I bring that up because this is not an unusual scenario. This isn't like something I'm making up. This is something that's been in place and has been for some time, and most likely will be for some time as well. This is not a, I don't want to say a risky idea or a, I don't say gimmick. So I'm actually going to shift gears here for a second, and I'm going to go over to a different illustration. And this, again, you're going to get all of this in an email at the conclusion of the presentation that you can go back and look at any time. But this came from Prudential, probably an insurance company you've heard of, and it talks about how term policies end at a specific point in time. Permanent policies can last as long as you live and cover needs with an unpredictable extended end date. But here's the thing I really wanted you to see, and I hope this is big enough for you to see. But again, if it's not, you'll have a recording, and you'll have this document that you can actually look at. But a couple key things here I thought would be informative to you, and that is way over on the left. It says term, a traditional protection. So again, this is a term policy. No cash value, typically provides life insurance coverage for a specific number of years When that period ends, the coverage ends. Some have a feature that enables you to convert the policy to a permanent one. This is key, without having to medically re-qualify if you convert within a specific time. It may be for you if you need life insurance protection for a specific number of years or for a specific age, such as covering a mortgage, as I mentioned, backing a business loan. If you unexpectedly die and you haven't had time to save up for college savings expenses. As it says, often generally less expensive than permanent insurance. It says down here again, the death benefit is guaranteed and fixed, and there is no cash value that goes along with it. Now the next one here is term also, and everything is still the same with one difference, and that is, this is kind of new, is that upon the satisfaction of certain conditions, such as a period of time, etc., you will, and you're still alive, you are refunded all the premiums that you paid. So that's always kind of the big complaint about term. Oh, I paid all these years and I never get it back. Well, you'll get it when you die, maybe. But here, what if you live, I guess. So in this case, you would get your money back, all the money you paid. Now, admittedly, your premiums are going to be a little higher than they are with the traditional term because you're getting this added benefit. So that kind of covers the two types of term policies that are available. Now we're going to kind of flip over here to 3 examples of permanent, or what they called cash value. Now the first one in yellow here is whole life, and you may have heard about this from your parents or grandparents, because this was the very first type of life insurance that was ever created. And you buy it, you can see here in the second box down, it has a set premium. It has essentially a predictable death benefit. It provides a lifetime of coverage for a guaranteed price with a guaranteed death benefit. Everything is guaranteed and fixed. It's pretty much, to me, it kind of reminds me a little bit of like Social Security. You're going to pay into it all these years, and you're going to have this very defined benefit that you can look up. Okay, I'm going to look up what am I going to, what's the predictability is the death benefit, but again, there's really no variation. You can't reduce your premiums. You can't modify the terms. I recall the first example of this was Gerber baby food. I remember used to, on the back of the box, you would see buy your child whole life insurance, and you think, this is insane. The child is 6 months old, but on the other hand, you think about it, if you buy it and maybe you buy kind of a bit more than the child needs for sure, it stays with that child forever. So just kind of interesting. Well, when things like mutual funds and those kind of things came out, it used to be that people would put kind of all their money or all of their free money into a whole life policy, and they didn't really have money available for mutual funds or individual stocks in particular. And then you heard companies like Vanguard came out and said, oh my gosh, you shouldn't be spending all that money on whole life policies because you're really not going to get that much coverage for your premium. What you ought to do is, and you heard this phrase, buy term and invest the difference. Well, insurance companies aren't stupid, and I think if you go to any major city in the United States, one of the largest buildings in every downtown is usually the insurance company in town. So they came out with other alternatives, and one of them here is called Universal Life. Only the insurance companies do they come up with these crazy names. This is insurance that can last a lifetime. Now here's a key: with flexible premium payments and a minimum interest crediting rate guaranteed by the insurer. Wow, what does that mean? Well, bottom line, what it means is the insurance company is going to take the money that you pay into these premiums, and they're going to cover the cost of insurance, number one. And then number two is they're going to take it and invest it in bonds or some kind of fixed income investment. So this universal life gives you the ability to change your premiums, adjust your death benefit, adjust the duration of the guarantee against lapsing if you don't make a payment, guaranteed minimum interest crediting rates. So, but again, you can see that while the death benefit is guaranteed, it can be modified. Now, on the other hand, the cash value is not guaranteed because the investments are not completely predictable. And you could actually have a scenario where if the bonds, the fixed income, woefully underperform, you actually could kind of get this letter from the insurance company saying, golly gosh, we really didn't plan on this, but we need to ask you for a couple $100 extra bucks this year. So that can happen. And then last but not least is variable universal life. And it's variable because literally everything is variable. Death benefit is variable and flexible. You can choose yourself the investment options in which to allocate your premium payments. You can match those investments to your own risk profile. You can adjust everything, the premium payment, the death benefit, the lapse period. Now, so this gives you the biggest control, and you could even invest in volatile times in investments that are very much like those in the universal life policy. Okay, so you can make this like investing in cash or bonds, or you can make it investing 100% in stocks. Now, what's the downside? Well, the upside is, your cash value accumulation could really be quite robust, definitely much more than whole life and more than universal life. The downside is just the opposite. Is in a significant market downturn, your cash value could really go down, as well as your death benefit. So kind of whole life is the most conservative alternative. Universal is the kind of moderate alternative, and variable life is, the greatest upside potential as well as the greatest risk. Okay, so and I think the other key point is these aren't mutually exclusive. So you could say, I know that I am going to change my houses. I'm going to move up into larger houses as time goes on. So I want to make sure that I always have some kind of insurance to pay off some or part of the mortgage. And so you might have some kind of a permanent life insurance policy. On the other hand, you might say, well, my child is 17 and is going into college at the end of this year. I want to make sure that I don't die in the next 5 years or 4 years, while he or she is in college. So you take out a little, or maybe you got 2 kids, they're 5 years apart. You take out a little 10-year term policy just to cover that. So, you could, hypothetically, there are people who do not invest in mutual funds, stocks, exchange-traded funds. I do have some people that don't invest anything outside of life insurance. They have this little traditional policy, again, to cover something like a child's education. They have a universal life policy to cover perhaps their mortgage, and they have the variable life policy to cover, estate taxes, and or it becomes their retirement fund down the road. So you can cafeteria style have more than one. Okay, so we're going to go back to our presentation here. And so I did tell you about, these different types of policy. Well, there's another new one that's kind of sliding in here under the universal life. And that one is called, oh, get over here. It's called fixed indexed universal life. Well, what does that mean? Well, fixed, meaning that it's kind of like it's got a fixed rate of return, but it's indexed against some measurement, and it's a universal life insurance policy that we just talked about. So what does that mean? Well, what that means is when you talk, as I mentioned earlier, when you talk about cash value life insurance, when you make your payment as the policyholder, you pay those policy premiums to cover your death benefit. Then you pay any fees, policy fees and charges, and then the cash value has the potential to grow as more premiums are paid. And hypothetically, down the road, your cash value may be accessible through either policy loans or withdrawals. So, a fixed index universal life policy provides a death benefit plus living advantages, including income tax-free death benefit, tax-deferred cash value accumulation. Here's the big one: protection from negative market index performance. That's the biggie, because where we saw over here, we saw before that we could lose money, maybe not a lot, but we could lose principal with a universal life policy, and we could lose principal, and in fact, measurable amounts, hypothetically, from a variable universal life policy. So what do? Well, what we do is we instead purchase the fixed index universal life policy, which is tied to an index. But here's the key: is if the underlying index rises, let's say substantially, let's say it rises 15%, you might only get to keep 13% of that or 10% of that. Your upside potential will be capped in some way, shape, or form. But in return, you will never lose money. You will never see a negative statement of a negative life insurance statement. And a lot of people are worried right now that they've been through some pretty big recessions back in 2000, 2008. They see volatility in the stock market right now. So it's like, you know what? I'm willing to sacrifice those home runs on the upside in exchange for never, doubling up into a double play with the bases loaded. So that's what a fixed index universal life policy is and does. And there actually is just a corollary called a fixed indexed annuity that does kind of the same thing, but its primary focus is all on retirement monies. It's not really designed for a death benefit. So my point being is that this is not, again, a lonely product. There is a companion annuity product that acts a lot like it. So here's the key. Indexed interest may be credited to cash value based on positive changes in an external index, and the chosen crediting method, there's different ones you can pick. If we have a positive index result, then our index is credited, but if we have negative results, there's no cash value loss. And this index interest credited is locked in every year. So it's not like you have, 5 good years and then one, what kind of year, and you lose everything that you've accumulated. That's not the case. It locks in. So this shows us how fixed index universal life policies offer the built-in annual reset feature. The cash value is not actually participating in the market or investing in any stock or bond. It's actually just in this rudimentary index. And once it's locked in, it can never be lost due to market volatility, even if the index drops below the amount. So we can see here this chart shows a hypothetical example of how the cash value is protected when the index drops. Even though the index performance is negative, the cash value is locked in and holds steady. And likewise on the next page here, whoop, too many. It shows us that this is key too, is when the market does head up, as we see here with B starting to rise, the cash value above does not have to make up for all the previous losses. Its value can increase on any policy anniversary in which a positive index change takes place. So that's key here. It's not like this B has to get all the way up to where it was. Even if it's just positive, then the cash value gets positively credited. Okay. So these three benefits combined into one product can make this a very effective option with life insurance protection. Second, with what Einstein once called the eighth wonder of the world, compound interest, and then unique tax advantages exclusive to life insurance. And I kind of put the again, just to show you some variety here. This PowerPoint presentation was put together by Allianz. You can see that in the lower right-hand corner. Understanding these different life insurance policies, this is a document published by Prudential. And then finally, what I've got here is this is from Protective Life, a different insurance company. And this is, again, is an indexed universal life, and they're advocating how you make a premium payment. With each payment, your cash value grows. There's subtracted policy charges and expenses to pay for the death benefit. The cash value grows based on the allocation made to the indexed and or fixed accounts. You can access your cash value through withdrawals in loans, and this could be used for unexpected expenses or for an emergency financial resource, as a financial resource. And then the policy's death benefit is paid to your benefits tax-free. So it says here, what happens if the market index drops? Your cash value is protected because you get a guaranteed minimum interest rate known as the floor rate. And just how does Protective keep this simple? This product allows clients to earn interest on positive growth in the S&P 500 with a maximum, here's a key, maximum cap, a rate of 9% on the upside. So you can't earn more than 9. That's not too shabby, though. On the other hand, you'll be protected from any loss, as your policy will never return an interest rate of less than 0%. Because we apply a more practical rate and keep policy fees low, you have the potential to grow more than cash value. So I know insurance is probably not the sexiest thing that we want to talk about, but I think you can see that it's probably the hidden child there, that there's a lot of utility that these different types of policies can work in your life. So, you know, again, back to hypothetically, if you've got children that you're concerned about for college, you know, maybe you look at a short-term traditional policy. If you're married and you've got a spouse and you don't want that spouse to be burdened with having to make the mortgage payment, maybe you look at something like a term, maybe a return of premium term, or maybe a universal life product. If, on the other hand, you said, I'm tired of seeing all this volatility in the stock market, I'm tired of losing sleep, maybe you look at the universal life, or maybe at least you select a piece of the variable universal life for your stock exposure as opposed to an outside investment account. So just wanted to give you a little bit of a flavor for what types of policies are out there. You can go to any of these companies, Prudential, Protective, Allianz, every single one of them, and every single one of them has information for you, the consumer, on these different policies. And they also have life insurance needs calculators. So that's where you can go on there and say things like, I'm 40 years old and I'm married and I earn $100,000 a year and I have a mortgage of $250,000 and I have 2 kids, and bang, you put all that in, then it comes back to you and says, you know what, based on what you've just shared with us, you might need $500,000 in this and $100,000 in that and another $300,000 in that. So it's pretty user friendly, and I have a little worksheet too that I can use if you want to go through that. Well, the other key thing that's kind of interesting is that no insurance product, life, disability, or long-term care, in any of those, do you ever pay an out-of-pocket commission. Now, admittedly, they will pay me a commission or a referral fee, whatever you want to call it. But unlike stocks, like with a brokerage firm where you may pay a commission, unlike some types of mutual funds where there may be an upfront commission or a surrender charge, with life insurance, disability insurance, or long-term care insurance, that's not the case. You'll never pay an out-of-pocket fee. And secondly, if you ever wanted to meet with me either via webinar like this, a conference call, or in person, I don't charge anything for a consultation ever. So that don't let any fear of I can't afford this deter you. So with that, I will say thank you very, very much for joining me. I will, as I mentioned, close this out in a moment. This will compile, and then you will get an email saying from Cisco, which is who provides this capability, saying, you were in this webinar. Here's the slides. Here's the recording, and then probably by the next day or so, I will be sure to upload this to my YouTube channel. So if you want to watch it there, you can do that at your convenience. So with that, I'll say thank you very much. Have a great evening, and I'll look forward to speaking to you soon. Thanks again.